Thinking of upgrading from HDB in 2026? Watch this first. If you're currently staying in a HDB and thinking of upgrading to a condo this year, let me be very honest with you. This decision can either accelerate your wealth or set you back 5 to 10 years. And most people don't realize which side they're on until it's too late. So in this video, I'm going to break down whether you should upgrade now, what most HDB owners get wrong, and how to structure your move properly. Because upgrading is not just about lifestyle, it's always a financial decision first. Now, let's start with the biggest question. Should you even upgrade now? If you've been following the market, you'll notice something very interesting. New launches are moving fast. Prices are holding, climbing even. Pinery Residences broke 2,700 per square feet in Tampines West, selling 92.5% in one day. Villa Bay launched next to Bayshore MRT and the crowds went crazy. People are snapping up launches left, right and center. But yet, at the same time, HDB resale demand has slowed. In Q1 2026, for the first time in 7 years, HDB resale flat prices dipped by 0.1%. This was not sudden. It follows 4 consecutive quarters of slowing momentum in 2025 from 1.6% growth down to near zero. And now it's finally tipped into negative territory. Why? Well, first, supply is increasing. Between 2026 to 2028, over 53,000 HDB flats will reach its MOP, which is about 58.8% more supply compared to the previous 3-year period of 2023 to 2025. This creates a clear shift in market dynamics because more homeowners will be entering the resale market at the same time, all competing for the same pool of buyers. At the same time, the government is ramping up new HDB launches with 17 to 19,000 BTO flats coming into the 2026 market alone. Waiting times have also shortened significantly compared to the COVID period, which means buyers today are no longer forced into the resale market like before. So, what does this mean in reality? Well, firstly, buyers now have options. They can choose between resale units, brand new cheaper BTOs with a shorter wait, or even consider upgrading into private property if the numbers make sense for them. Because of this, the urgency that we saw previously, where buyers were rushing in and offering above valuation, is already fading. And when demand becomes more selective while supply increases, naturally, sellers are going to lose some of their pricing power. That's why we're starting to see the market stabilize, not because demand has disappeared, but because buyers today have more choices and more time to decide. Next, demand is softening. Resale transaction volumes are already down about 4.5% year on year, which tells us something important. It's not that buyers have disappeared, but they are becoming more selective and more price sensitive. What we're seeing now is a shift in buyer behavior. Previously, many buyers were willing to move quickly and even pay above valuation just to secure a unit. Today, that urgency is no longer there. Buyers are taking more time to compare, negotiate, and in some cases, simply walk away if the price doesn't make sense. A big reason for this is the widening set of alternatives available. Instead of stretching for resale premiums, many buyers are now choosing to wait for BTO launches, especially with the new shorter waiting times. When even your sales of balance flats have balance, that speaks volumes. Others are exploring new launch condos where the entry price, payment structure, and long-term upside may just feel more justifiable. So in essence, this isn't a demand collapse. It's actually a demand reset. Buyers today are simply more informed, more patient, and more disciplined with their finances. And in a market like this, the units that move are no longer just the available units. They are the ones that are priced correctly and positioned well. Third, buyer behavior overall is shifting. Instead of rushing in, the buyers today are approaching the market very differently. It's no longer about, can I afford this? But is this the right entry price? And what are my alternatives? We're starting to see first-time buyers spend more time evaluating each option, not just across different projects, but even within the same development, comparing stacks, facings, floor levels, and price gaps much more carefully before making a move. In a newly MOP'd HDB unit that I recently sold, buyers were arranging viewings based on specific stacks and floor levels, something I must say I've never experienced in the years before 2026. There's also a much stronger focus on downside protection now. Buyers are starting to ask questions like, if the HDB market continues to slow further, will I be stuck? And am I buying at a price where I still have room to exit comfortably given my 5-year MOP? Because of this, negotiation has become a much bigger part of the process. Offers are coming in more conservatively, usually around 20 to 30k under the SRX valuation. and buyers are less emotionally driven as compared to before. If a unit feels overpriced, they are perfectly comfortable stepping back and waiting. At times, the same buyer even comes back 2 to 3 weeks later asking if the seller is now serious about selling. Another key shift is that buyers are no longer just comparing properties, they're comparing strategies. Some are considering whether to upgrade now or later, and whether going straight into resale directly or renting while buying a new launch makes more sense. So overall, it's not just a slower market, it's actually a more calculated one. And in this environment, the winners are no longer just the best units, but the ones that align clearly with what today's buyers are trying to achieve, whether that's value, flexibility, or future upside. So what does that mean for you as a seller today? It means we're in a transition phase whereby private property prices are pushing up while HDB buyers are becoming more cautious. And this creates a very specific window because if you're an upgrader, you're playing both sides. You're selling in the HDB market and buying into the private market. So timing matters, but not in the way most people think. Most people try to time the market like this. Should I wait for private property prices to drop? But here's the reality. If private prices drop, HDB prices usually soften too. And that's because the two markets are actually connected. When overall sentiment weakens, it doesn't just affect one segment. It flows across the entire property market. So what actually happens? Let's say private property prices do drop. You might be able to buy your next private property at a slightly lower price, but at the same time, you're also likely selling your HDB at a much lower price, which means your net position doesn't improve much. In fact, in some cases, this can even work against you because while your selling price drops, your loan quantum, interest rates, and holding costs don't necessarily adjust in your favor. More importantly, timing the market is almost impossible. By the time prices clearly drop, most buyers have already stepped back, transactions have died down, and it actually becomes even harder to sell your current property efficiently. So instead of trying to time the market direction, the smarter approach is to focus on timing your position. Ask yourself, are you entering at a price that still gives you room for future growth? And are you structuring your move in a way that protects your downside? Does the next property put you in a stronger position 3 to 5 years from now? Because in real estate, you don't make money by perfectly timing the market. You make money by entering the right asset at the right price with the right strategy. So let's talk about that. There are 3 things every upgrader must get right. First, your affordability structure. Not just how much you can buy, but how you buy. Because I see this all the time. Clients come in and say, my budget is $1.8 million. But when we break it down, that number doesn't account for CPF usage, accrued interest, buyer stamp duties, law firm expenses, loan structure, monthly cash flow. So they end up stretching and become very tight after the purchase. That's the fastest way to regret an upgrade. A proper upgrade should feel comfortable, sustainable, and still leave you room for flexibility and rainy days, not just barely affordable. Second, your entry price versus your exit strategy. This is where most people go wrong. They focus way too much on the project hype, facilities and amenities, show flat decorations that don't even come with the property, or nice renovations in a resale unit that's likely already priced in, and not nearly enough on what price they're entering at and how much did the neighbors in the same project enter at. Because in today's market, 2 people can buy in the same project and have completely different outcomes. One enters at a good price while the other overpays. And 3 years later, one makes money and the other struggles to exit and thinks property is a scam. So when you upgrade, you must stop thinking just like a homeowner and start thinking a little more like an investor, even if this property is meant for own stay. One method I use when spotting value buys for my clients is to plan the exit and position for the future sale even before we sign on the dotted line to purchase the unit. That brings me to my third point, your exit strategy. This is the part nobody talks about, or they glaze past it too quickly and touch on it very briefly. So let's break it down. When you buy your next property, you must already know who you're going to sell to in the future. Is it another upgrader, an investor, or a downgraded buyer? Because different projects attract different exit pools. On a deeper level, it's also important to think like the next buyer. Put yourself in their shoes. If they're buying for own stay, would they prefer a higher floor unit or a lower floor one? Is the layout practical, usable? Is the kitchen big enough? How can I actually place furniture along these slanted walls? most? What other options will they be comparing your unit against when you eventually sell? And just as importantly, what price are your neighbors likely to be entering and exiting at? Because if you don't think about this early, you may end up buying something that looks perfectly fine today, but is much harder to sell later. And that's exactly why entry price and exit strategy matters so much. Not just because of how much you pay today, but because of how much flexibility you still have when it's time to exit. Let me give you a classic example. New launch versus resale. Resale often feels safer. You can see the actual unit, walk the grounds, check the facilities, talk to residents. You know exactly what you're buying. But here's what you can never do. You can never turn back time. Most buyers never check what the first owners entered at. They also rarely check what similar neighboring units are currently held at. So when it's time to sell and both owners are competing for the same buyer pool, who do you think has more room to negotiate? And don't get me wrong, the first owner will always still want the best possible current market price. But what we can't control is seller urgency. Everybody's situation is different. Some may be upgrading out of urgent needs because a new baby's on the way and a 3-bedroom compact simply doesn't cut it anymore. Some may need to relocate for work or for school. And if and when this urgency kicks in, what do you think they'll do to make their unit move? And when that really happens, which unit is going to sell first? Will it be the first owner who entered at a much lower price with more buffer to adjust, or the one who bought in later at a much higher entry? And in the event that the market does soften even slightly, who is more likely to get stuck? That, my friends, is the hidden resale risk. It's not always about the project being bad. Sometimes the problem is simply that your entry has left you with very little room. So when you're planning your next move, consider this aspect too. To clarify, the question is not simply, should I buy new launch or resale? The real question should be, how do I structure this move in a way that gives me the best balance of affordability, own stay needs, flexibility, and exit potential? Because every decision you make here has a trade-off. You might get more space but compromise on your entry price. You might get a better location but stretch your monthly commitment. You might secure something that's comfortable for today but limit your options when it's time to move again. And this is where most upgraders get stuck. Not because they lack options, but because they're trying to optimize for everything at once without a clear strategy guiding the decision. Now, let's lay out the cards. New launch. Everything is new. There's no need to renovate much. Progressive payment scheme helps, and the initial cash outlay is usually lower. Some newer units are even harmonized, but you're also paying a premium for that newness, and you may need to rent. Now compare that to resale. Resale is usually a little more straightforward. What you see is what you get. Price per square feet is usually lower, but the layouts also tend to be less effective. You're paying for less space efficiency, places like your AC ledgers and your RC ledgers. And there's usually a higher upfront cost and immediate loan servicing. And overall, less of a future growth story to lean on, I guess. But that also means that you don't need to rent. So which one is better? The truth is, neither is automatically better. It depends on your strategy and your family's needs. If your priority today is lower initial commitment, better cash flow flexibility, and you're comfortable waiting, then new launch can make a lot of sense. But if your priority is immediate use or rental and buying into something more tangible today, then resale may be the better fit. And that's why I always say, don't ask me which is better in general. Ask which is better for your stage, your numbers, and your risk tolerance. Now, let me address something I also hear a lot on the ground. I'm scared I upgrade at the wrong time. That's a very valid concern. And property is a huge commitment. You're not just putting in money, you're making a decision that affects your lifestyle, your finances, and your future plans for both yourself and your family. It's not just numbers on paper, it's about where you'll be living for the next few years, and about whether this space works for your daily life, whether the financial commitment feels comfortable month after month. What happens if you lose your job? And because of that, it's completely normal to feel hesitant. No one wants to make a move and then look back thinking, maybe I should have waited. But at the same time, this fear of getting the timing wrong is exactly what keeps many people staying stuck. They keep waiting for clearer signals, for better prices, for more certainty. And in the process, they delay a decision that could have been already structured properly from the start. So the question is not whether this concern is valid. It is. But here's the hard truth. There isn't perfect timing. Only good entry and bad entry. And more importantly, good planning or poor planning. Because the market is not something you can fully control. Prices move, interest rates shift, policies change. wars rage on. What you can control is how you position yourself within the market today. Because if you structure your upgrade properly, even if the market moves slightly against you, you still have options. You can hold, you can stay comfortably, you can wait for the market to recover. Your decision doesn't become urgent. But if you overstretch, if your finances are too tight, or your entry price leaves no buffer, then even a teeny tiny shift in the market today is going to feel very, very stressful. And suddenly, every interest rate movement matters. Every price fluctuation feels amplified. You find yourself constantly checking your home valuation, wondering if it's dipped or grown. But your home's not a stock, and instead of making decisions from a position of strength, you start reacting emotionally to short-term movements. That's when the pressure kicks in, and instead of moving forward with clarity, you're forced to react under pressure. The goal isn't to get the timing perfectly right. The goal is to structure your move in a way where even if things don't go perfectly, you're still in control. That's why, instead of asking, is now a good time to upgrade, ask, am I upgrading the right way? In simple terms, upgrade if you have stable income, you can comfortably service the loan, and if you're entering at a reasonable price band. You should also have a clear 4 to 7 year plan. Hold off if your finances are tight, if you're uncertain about your timeline, or if you're buying mainly on emotion. And this is the most important part, because upgrading is not a race. You don't need to rush. You don't need to compare. Life is a marathon and everybody grows at their own pace. But do know this, when you're ready, you'll need to do it properly, because one well-structured upgrade can change your entire property journey. But that's a story for another day. If you want help restructuring your upgrade, understanding your real budget, or comparing specific projects properly, just reach out. I'll walk you through it step by step. That's all for today, and I hope you picked up something useful. I'm June, and I'll see you soon.